I'm GM of ABC Bullion, and on behalf of ABC, I'd like to thank Kerry Stevenson for the opportunities to speak here today. 2 years ago, I had the privilege of speaking at the symposium in Melbourne. I was bullish about gold then, and I am now. But timing is everything, however, and investors who were bullish then had to be cleared out by the market before the rally could really get going towards the end of last year. If you look at positioning on the CME, you'll notice that managed money investors turned net short in July 2018 before finally turning long again in last year prior to the impressive rally. That has relevance to gold now because if you look at gold investor positioning today, it's almost the same as it was in November 2017 when I last spoke. Longs are running at about 21 million ounces, net positioning just under 18 million troy ounces. Total ETF positioning has gone from about 68 million ounces to over 82 million ounces. So investors are very, very committed. After 24 years of trading gold, silver, and PGM platinum group metals, I could be forgiven for thinking that this is what they call a crowded trade. However, those with patience may turn it to their advantage. The other link to November 2017 is that key political elements present then have only become worse. Brexit has changed into a stark binary choice of deal or no deal, or in other words, something less good or something worryingly bad. On the US side, just to mention two notable developments, one is a painful and growth-sapping trade war with China, and the other is an America that stood aside from its commitments in Syria, allowing Turkey to begin an offensive against an American ally in the region before regretting it 72 hours later. When the most powerful nation on the planet doesn't know what it's doing strategically, we all have problems, and that benefits gold. Today, I'm going to discuss factors that are influencing interest rates and interest rate expectations, the natural interest rate, US debt, and I'll follow that by talking about gold price targets and key support levels. Gold won't get an explicit mention for quite a while. In fact, if this speech were to last as long as the 20th century, and some of you may feel that it will, then gold would really only make an appearance around the time of the Berlin airlift. Last decade since the GFC saw a huge and unconventional response from central banks, initially to avoid systemic instability that would rob many of us of savings and livelihoods, and then a sustained effort to try and lift economies out of post-GFC stagnation. Over a decade has elapsed since the interest rates first hit zero in the US, about half a decade since the ECB followed suit. Since then, the US has tried to normalize unconventional policy. However, that period of normalization has been very brief. Unconventional policy remains in place with the Bank of Japan and the European Central Bank, with the ECB introducing negative interest rates in 2014, and the Bank of Japan introducing negative rates in 2016, January 2016. And if you see here, you can see where that policy is carrying on with the ECB and the BOJ, and slightly falling away with the Fed. Actions included asset purchase leading to huge expansion of balance sheets, unconventional behavior such as forward guidance, which I think a lot of us are now used to or treat as normal, but it's actually unconventional. The Bank of Japan entering real estate investment trusts, buying real estate investment trusts and Japanese stock ETFs to the tune of around about $57 billion US, plus the above-mentioned move to negative rates. The expansion of the ECB and BOJ continues apace. You can see that the reduction in the Fed's balance sheet with the introduction of QT, or quantitative tightening, as the Fed allowed around $600 billion to roll off its balance sheet. However, what's very clear is the Fed balance sheet stopped contracting in August, and it started to rise again, so normalization appears to be over. Now, major economies haven't experienced significant growth since the GFC. You can see that China is particularly affected. So whilst unconventional policies might have averted disaster, they haven't translated into a full resumption of growth. They've also inflated asset values and conferred more wealth on existing asset holders. That's undoubtedly contributed to some of the political angst that we've seen since 2008. Now, remarkably, if you look talking about inflation expectations that have come out of this low growth, Japan's experienced almost 3 decades of really low inflation, and the introduction of negative rates has led to lowered inflation expectations, not because you'd expect it to, but because when expectations of really low inflation are thoroughly anchored, it seems almost nothing can shift them. And that has some kind of relevance, I think, to the future expectations of behaviors of other central banks. At the symposium 2 years ago, I said that interest rates were declining and converging, and they've continued to do so. The key drivers of that are a surplus of global savings over capital formation, which is a broad definition of investment. That excess amounted to about $1.25 trillion in 2017, which is the last year I have data for, and adds up to almost $5 trillion between 2013 and 2017. For the period that I don't have data, since 2017, I think the surplus is likely to have grown. The reason why I think that is because of increased uncertainty over trade and global growth beginning to drag. And that's chiefly characterized by the ongoing trade dispute between China and America that I mentioned. It's also probably the result of recently developed economies reaching some kind of higher level of investment maturity, and that slows down their investment demand. The natural interest rate, which I'll move on to now, defined by the Swedish economist Knut Wicksell, is the interest rate compatible with capacity for a natural rate of output and a stable price level. It's an unobservable rate, but it can be implied or calculated, and I've calculated it according to market convention, although there is significant argument about which convention you should use. Previously, I've talked about the real rate of interest, which is the headline or the nominal rate minus inflation, but I've introduced the concept of the natural rate here because policy choices can influence the real rate in the short term, whereas the natural rate should signal a truer account of where demand for money really is. The natural rate has been in secular decline for the last 2 decades and it's fallen particularly sharply this year. And this is profoundly good for gold as an asset class, which you can see here, the price of gold operating in contrast with the natural interest rate. So let's look at the long-term outlook for interest rates. Federal Reserve published its own long-term expectations quite recently, and they're for Fed funds to stabilize at 2.5%. Leaving projected real rates at only about 0.5%, which is still higher than projections for other countries, particularly the Eurozone and also Japan. And they forecast really low nominal rates and probably and negative real rates. The only thing I'd say about the Fed's own projections is to achieve that 0.5% real rate, they've got to hit their inflation mandate of 2%, and they've completely failed to do that for several years now. If monetary policy has engaged such a powerful constellation of unconventional means, and growth has meandered along sluggishly, such as seen in the previous slides, what next? US interest rates peaked at about 2.4% before easing started again, meaning that any response to an economic slowdown will leave very little scope for conventional easing. This suggests 2 things. Unconventional policies will remain in play or make a return after a partial unwind. The second thing it suggests is that the US and other countries that issue their own currencies, i.e. not the Eurozone, may embrace modern monetary theory, MMT or modern monetary theory, a theory whose most appealing aspect to its believers or its adherents is that since governments have a monopoly on the production of money, they can issue exactly what they like. They can finance potentially unlimited fiscal boosts because they can't default. States can either print or tax to support their output of money. Money creation and government spending can continue until inflation is encouraged, at which point higher taxation and bond issuance reappears, and that can be used to dampen down price instability. The irony is that MMT has quite a few adherents in America, where it seems that full employment and price stability are already in place. But I'll address MMT because it's gaining a lot of traction out there and gaining airtime. It's already being talked about by potential American presidential candidates and their high-powered advisors. And where America goes, much of the world may follow. I agree in times of slump or stagnation, fiscal policy is probably more effective than monetary policy. And with interest rates at historic lows, government spending on productive uses such as infrastructure would be perfectly reasonable in countries like the States, which have aging roads and airports. However, there are several worrying points that are worth addressing. There is a degree of faith in the ability of government to direct spending in a way that is optimal, in a way that maximizes welfare to all participants in the economy, and the ability to rein in spending as and when it becomes necessary. It's a rare government that reduces the burden of taxation once the tax has hit the statute books. Also, implementation of MMT would require institutional changes that probably change the nature of central banks, avoided governments buying off one section of society in preference to another, or being really truly captured by the election cycle. These criticisms are somewhat philosophical, and they're based on a general mistrust of government choices. However, the following ones are harder hitting. MMT appears to be based on a closed economy model, and it says relatively little about expansion causing the exchange rate to fall rapidly, and the implications that has for both domestic and overseas users of the dollar, whether the US dollar or the Australian one. Or other nations would find the external value of their currencies being affected against that reserve currency. MMT also appears to ignore or duck the issue of moral hazard. Firstly, in the sense of a monetary expansion that would allow excesses to build up within the system, within the private sector and the banking system. We've been here before quite recently, and we're still paying for those consequences. The second element of moral hazard is the market discipline imposed by private sector domestically and overseas who normally lend to governments. They traditionally finance budget deficits, and if that moral hazard goes out of the window, that could have unforeseen consequences. Additionally, the portrayal of the MMT mechanism of achieving full employment and stable prices appears a little bit too smooth and mechanistic to reflect the dynamic pathways that exist that prices of employment follow in the real world. It's also unlikely that the hidden component behind unemployment, which is declining workforce participation, responds well to demand stimulus. And maybe that's where the jobs guarantee part of MMT comes to the fore. Finally, it's not the full list of criticisms of MMT, by the way. Even governments cannot build up debt forever. Lenders must still be incentivized to hold debt or to hold the currency, and budget projections show an alarming increase in the share of interest cost of debt alone in certain countries. On the plus side, MMT seems to identify that governments should run deficits that allow the private sector to run a surplus, and that appears to be the most stable outcome for the economy. But if the world economy does slide into recession or slower growth soon, expect to hear a crescendo of voices calling for MMT. And if there's a real collapse in demand, then like Keynesianism before it, it would likely prove a better way in the short run to get demand back into the economy than yet more central bank-led, unconventional policy. Nonetheless, you have to be cautious. And the reason why I'm mentioning it is, as it gains more traction, it's worth pondering what its consequences are. It's certainly not a fiscal free-for-all. Now, all this talk of MMT and the ability of governments to produce their own money leads neatly on to the outlook for US debt. Now, 2 years ago, I said that debt is well connected with rises in the gold price. It explains about 80% of gold price movements as a single variable over the long term. US debt has only grown since then, courtesy of a political failure to grapple with spending and also some ill-judged tax cuts that whose impact on the American economy are probably already fading from memory, or probably will do by next year, but they'll live on in terms of the deficit and the future path of US debt with a poisonous half-life. US debt projections for 2027, this is, by the way, just a gold regressed on US debt if you want to look at how US debt impacts on the gold price. It's quite a nice positive relationship, and it's a good explainer with an R squared of almost 0.8. Now, I'm contrasting here debt projections made in 2017 against debt projections made by the CBO, the Congressional Budget Office, in 2019. So you can see they've increased fairly dramatically. Projections for 2027 have increased by $1.25 trillion in the last 2 years alone, and projections for 2024, half a decade away, are up by roughly $1.5 trillion. That's just in a 24-month period since I last spoke about US debt. It's It's a worrying reminder of how quickly and how inexorably debt grows. In a decade's time, US federal gross debt will have increased by almost 60% compared with this time a year ago. So, what do I think about projections for the gold price? The above scenario is one where I've described a world where major economies have lower interest rates for further into the future, more debt, more ongoing unconventional monetary policy, and the chance of unconventional fiscal monetary policy in the form of MMT in the future. The first 3 points support a major bull case for gold. The latter point introduces a degree of uncertainty about deficits, financing, and the external value of currencies that should benefit gold. In addition to the above, gold will enjoy a tailwind from a market increase in total wealth in India and East Asia. Total wealth is expected to grow by about $34 trillion during the coming decade in a region with a market affinity for gold ownership. But let's look at gold price projection from here. Gold has significant above-ground stocks and substantial geological reserves, and the current price certainly incentivizes production. So not surprisingly, I prefer technical analysis to make inferences about the likely future price of gold as opposed to, say, wheat or platinum. Now, hopefully there I am. So this is quite difficult for some of you to see even from the front row, so I'm going to talk you through some of it. Point is that gold has made many of the key targets shown on this very long-term chart. It's long-term enough that the left-hand region really encompasses Ronald Reagan and Iran-Contra and so on, so it's that far back. So, it's quite a nice long-term look at the gold price. Now, I expect the price, because we've made this $1,500 and fallen short of the $1,590 target, I actually expect that there's a good chance the price will roll over and weaken from here, because generally with this kind of projection, that's what the gold does, or that's what any commodity or asset does. It reaches a target, and then it slightly fades away, and we've clearly reached the $1,500 target. If you're long of gold and you're looking to trade major price points, then it's worth being ready to liquidate part of your position when these targets are reached. So you can see that from when gold actually reached a recent major low, and I suspect you can beginning to see the beginnings of that having just exceeded 1,500. So liquidate part of your position when targets are reached and wait for the market to cycle back in the opposite direction as the market appears to expend energy reaching these levels. Major price targets to be particularly wary of include 1,590 and, for the longer term, 1,740. I anticipate the market would pause at the first level, and a failure to close above that level for 2 consecutive weeks of trying ought to make you reconsider future outcomes carefully. Saying that, as plenty of smarter people have said, the only position to have in a genuine bull market is to be a long position. So, what I'd like to look at is the market assessed chances of the price reaching selected higher levels. And these selected higher levels are just the ones on this chart, just for the sake of ease. And the probability of gold reaching or exceeding a particular price by a particular date can be inferred from option price calculations. The caveat is that the market is bullish already, then it will tend to overemphasize the probability. But nonetheless, it's a whole lot better than guessing it all by yourself or asking your average gold blogger. There's a slightly clearer, if you look at this, slightly bigger. I can provide these to people if they're interested later. So I'm going to shoot forward and then shoot back. So these are the probabilities in percentage terms calculated earlier this week for the gold price reaching those levels in US dollars in 1 year's time, stretching out to 5 years' time. You can see that obviously the percentages increase the further out time-wise you go, because of course you've got more time to reach those levels. There's more optionality in it. So just going back a little bit, where could gold decline to before the technical case for gold is challenged? Because gold prices don't always go up, and it's an interesting way to look at it. People say, well, gold price could go this level, that level. What about looking at another way, which is to say, where could gold go to? I think that the key short-term supports that you've really got to look at in US dollars and Australian dollars are here. And 1445, 1413, these are all reasonable levels that the price could roll back to. But if we closed below 1377 in US dollar terms, I'd be pretty concerned that the recent bull market was actually being severely undermined. And in Australian dollars, you can see 2067, 1988, 1909. A close below 1909 would be really concerning, I think, for Australian dollar gold bulls. On the other hand, as I've said, key resistance in US dollar terms, 1590 and 1740. It's a little bit harder to call because we're already pretty much seen all-time highs with the Aussie dollar gold price. But I'm going to say that 2347 and 2542 are going to be quite difficult levels for gold in Australian dollar terms. And if we get there, I'd expect to see the price roll back a bit. So, good grief, I'm getting pretty close to my, you'll be relieved to know I'm getting pretty close to my time limit as well. So let me summarize. Okay, we've got an environment where declining natural rates of interest, continuation of unconventional monetary policies, fears of a global slowdown, persistence of weak demand, particularly in Japan and the Eurozone, and signs of weakening demand in China. Unconventional monetary policy hasn't returned the world to pre-crisis levels because of this weak demand, plus significant hangovers from the aftermath of the great moderation of 1990s. There was arguably considerable overinvestment about 7 or 8 years ago, or in the previous decade. That's left the world trapped in a low interest rate environment. It's an environment which we know favors gold now, and it should continue to favor gold for a considerable period of time. And of course, when I say favors gold, that means gold physical, and it means gold equities. Thank you very much for your time.